Welcome to the debate. Our focus today is Ford's really rapid strategic maneuver following a severe operational shock. Last quarter, as you know, the company suffered a huge hit, somewhere between, $1.5 and $2 billion because of a single point of failure. That fire, of course, at the Novelis aluminum supplier plant. And yet, despite the setback, Ford still managed to post a pretty strong $2.4 billion in net income for Q3. So their response is aggressive, it's direct. They're launching this major ramp-up of their highly profitable F-150 and Super Duty gas and hybrid truck production. We're talking adding 50,000 units annually starting Q1 2026. And crucially, they're fueling this expansion by adding new crews and, reallocating hundreds of workers from the currently idled F-150 Lightning EV line. So the central question before us really is whether this plan, which, let's face it, prioritizes maximizing current profitability through manufacturing concentration, represents a necessary pragmatic financial recovery. Is it just leveraging where the company has immediate market strength? I maintain, look, this is the only really fiscally sound response to an unexpected catastrophe of this scale.
Yeah, I come at it from a different angle. While there's no denying the pressure, obviously, to recover that multi-billion-dollar loss quickly, I really think this tactical shift introduces significant self-imposed concentration risk right into their core manufacturing system. And maybe more importantly, it fundamentally compromises Ford's strategic commitment to the long-term shift toward electrification. To me, this looks, less like prudent recovery and much more like a strategic retreat, kind of disguised as financial necessity.
Okay, let's start there then, necessity. When a company faces an unexpected shock that's approaching $2 billion, the fiduciary duty, plain and simple, is to stabilize the guidance trajectory, reassure the market. And you do that by leveraging your strengths. The source material, I think, couldn't be clearer on this. The traditional gas and hybrid trucks they are expanding production for are explicitly stated as more profitable and, importantly, use less aluminum than the electric Lightning. Maximizing output in this segment is just the quickest, most capital-efficient way to claw back that enormous loss and, maintain the momentum of their strong Q3 earnings. To suggest they should dedicate more capital or labor to the idled Lightning line right now, given the headwinds that specific segment faces, that would just be financially irresponsible in this kind of crisis recovery period.
Okay, that assumes we accept their premise that a company with, $2.4 billion in Q3 income, even after the loss, needs such an extreme, volume-centric reaction. Yes, okay, they need to stabilize guidance, fine. But I see a massive flaw in the mechanism they chose for this recovery. The core issue for me is the concentration risk. The plan calls for 45,000 of those 50,000 new units, 45,000, to be concentrated specifically at the Ford Rouge complex and the surrounding Dearborn facilities. This centralization is incredibly ironic, isn't it? The entire reason for this urgent volume push was a failure caused by a single point of vulnerability in the supply chain, the Novelis fire. Now, instead of, say, diversifying their supplier base or maybe their manufacturing footprint, they're basically applying that same critical concentration model to their final assembly output. So if any disruption, could be weather, labor, internal machinery failure, anything hits Dearborn now, they jeopardize nearly the entirety of their planned recovery volume.
That risk analysis feels a bit theoretical, though, and I think it ignores the reality of manufacturing velocity.
It's operational risk, not theoretical risk. That's the point.
Okay, but I would frame the centralization differently. Look, the ramp up in Dearborn, it demonstrates confidence, I think, in the maturity and the existing infrastructure of the Rouge complex. It is a highly optimized, mature system. Trying to diversify a 50,000 unit expansion across multiple, maybe less utilized plants would introduce massive complexity, new logistics challenges, and it would inevitably delay the financial recovery that's required. Ford is prioritizing the fastest path to output because, frankly, they cannot afford delays or missteps after sustaining that multi-billion-dollar loss. It's strategic velocity, in a crisis situation.
But this velocity, as you call it, it comes at the cost of the future. And let's talk about that long-term strategic compromise. Specifically, the implications of reallocating those 500 F-150 Lightning workers. Shifting the Lightning team, that sends a powerful negative signal. This is a structural decision, right? The production ramp-up starts Q1 2026, which means this isn't some, 2-month temporary measure. It's a multi-year commitment diverting specialized knowledge and resources away from a key EV platform. It sacrifices EV scaling capacity and potentially risks demoralizing or even losing personnel who've built specific skills in, high voltage systems, electric vehicle assembly. This structural pivot, I think, really undermines their ability to compete effectively when the EV market inevitably, and it will, reaccelerate.
That's an interesting point about skill erosion. I'll grant you that, but that perspective, I think, ignores the economic realities of managing a workforce day to day. The Lightning production was idled. It was idled due to slow sales, which were exacerbated by factors like the anticipated end of federal incentives. Keeping 500 highly skilled workers sitting idle is a massive fiscal drain and, frankly, a waste of human capital. So transferring them literally next door to build highly profitable traditional models that are currently in high demand, well, that seems like the best use of personnel until the EV market stabilizes. This is just efficient labor management. It maintains employment for those workers. Importantly, it retains them within Ford's overall manufacturing system, and it directly contributes to the 50,000-unit goal required to repair the company's balance sheet. They are preserving the workforce, I'd argue, not sacrificing them.
Preserving their employment, perhaps? Yeah, but sacrificing the focus of the EV division. I mean, when management explicitly frames gas and hybrid trucks as more profitable, right in the context of expanding their output, they are essentially viewing the EV segment, which is the necessary future, let's be clear, as a costly liability that needs to be starved of resources to feed the legacy platform. The short-term profitability boost, it creates a structural disadvantage, I think, against competitors who are maintaining rigorous investment in scaling and improving their EV lines even through these temporary downturns. Their Q3 income actually proves they have the underlying financial health to absorb the supplier shock while still continuing to invest strategically. Instead, they opted for this extreme tactical shift that risks ceding long-term ground.
Well, that's where the market reality intervenes, doesn't it? They're expanding production where the market is demanding volume right now and where the margins are demonstrably higher. It would be, I repeat, fiscally irresponsible to pour more resources into an idled line when you're facing a potential $2 billion recovery effort. Furthermore, let's just circle back quickly to the concentration issue. You focused heavily on the risk inherent in centralizing those 45,000 units in Dearborn, okay? But you overlook the cost of compliance, the complexity. Centralizing production at a complex like Rouge allows Ford to implement the new third shift and integrate over 1,000 new hires rapidly, efficiently. Trying to distribute that volume increase across, say, 4 different plants, that would require establishing entirely new logistics chains, new training protocols, new quality controls at each location, all of which just slows velocity and introduces myriad new points of failure in the management chain itself. They chose the path of highest operational maturity to maximize speed and quality assurance. That is sound risk management when the clock is ticking on a massive financial recovery.
See, I fundamentally disagree that it's sound risk management when the root cause of the whole crisis was a concentration failure to begin with. The learned lesson should have been diversification, surely. By centralizing 90% of this vital recovery volume, they are effectively placing a new, massive operational bet on a single geographical location. They've essentially traded the supply chain risk they just experienced for operational concentration risk. It feels like déjà vu, almost. And that concentration, it ties directly back to the EV compromise we talked about. By aggressively utilizing the existing mature capacity for gas and hybrid models, they are structurally reinforcing the reliance on the very products that, strategically, need to be phased down over the next decade. So the reallocation of the specialized labor, the maximization of the traditional truck line, it suggests that despite public commitments, the EV transition is now maybe a second-tier strategic priority, something intended to wait until Q1 2026 or later for really significant investment.
Look, the reality is that the aggressive push for this immediate volume is exactly what will secure the financial stability needed to eventually invest robustly in the next phase of the EV transition. They aren't abandoning the workers or the technology. They are ensuring the company survives this financial hit in the strongest possible position. Utilizing the idled EV line's workers maintains their skill set within the company, keeps them employed ready for deployment when market conditions improve. It is simply maximizing labor utilization until the business case for the Lightning line becomes compelling again.
But the decision risks costing them more in the long run, doesn't it? Sacrificing strategic momentum, increasing core operational risk, offer a short-term volume fix. Especially when, as we discussed, their balance sheet was already robust enough to weather the initial hit. It demonstrates, I think, a potential lack of long-term vision. They're prioritizing immediate margin recovery over necessary future resilience and market competitiveness.
My position remains that this plan is a robust, pragmatic response to immediate financial pressures and existing market demand. It capitalizes on their highest margin segments, uses existing infrastructure and available labor efficiently to rapidly recover a massive unexpected loss. And that ensures short-term stability and, crucially, restores investor confidence.
Well, I respect the urgency driving their decision, obviously. But the strategy, for me, risks significant long-term strategic compromise. The structural reallocation of dedicated EV resources, the aggressive concentration of this new 50,000-unit increase, it suggests a fundamental pivot away from essential diversification. They are trading, I believe, robust strategic resilience for immediate volume, locking themselves into a position of high operational risk and potentially compromised future competitiveness.
It really highlights the complex tension, doesn't it? That constant pull between securing quarterly financial stability and maintaining a focused, long-term strategic trajectory, especially in today's rapidly changing auto market.
Indeed, and how this concentration actually affects long-term efficiency, day-to-day operations, and whether the EV market allows them to simply pause and then restart without penalty, well, that remains the crucial unknown, I suppose, in the coming quarters.